This is Trading-Lesson48, delivered by Twegbe Hizugi. Forex, crypto, stock, options, bonds, commodities, futures, synthetic, and other chart-related traders. You're advised to subscribe, share, likes, and make comments. You can contact us for account management, training, consultation on +234 803 7597085. Traders are always thinking about the best way to maximize their profitability. And the two most important considerations are trade selection and position size. A new trader should focus primarily on swinging only the best 2 to 5 entries each day, which are usually second entries in the form of reversals at new swing highs and lows on non-trading days, maybe 80% of days, and spikes and pullbacks on trend days. Once a trader is consistently profitable, the next goal should be to increase the position size rather than adding lower probability entries. In general, most traders should work very hard to take trades in the first hour or two because those trades have the best traders equation, combination of reward, risk, and probability. On the daily chart, there is often a small tail below strong bull trend bars and above strong bear trend bars. Because limit orders trades are more difficult to evaluate accurately, beginners should avoid them. Be very careful about stop entries and only sell on a stop if you are at the top of the range as the market is turning down. Only buy on the stop near the bottom as the market is turning up. The market always raises to the top and bottom, suckering hopeful beginners into buying on stops at the top and selling on stops at the bottom. They just took at the strength of the spike up and down and ignored the trading range of the past 20 bars and end up doing the opposite of the institutions. Because so many of the trade setups are for scalps and most traders cannot make a living by scalping, you should be very selective during this time. Traders need to be aware that the trend that began at the open might not last all day, and the exact opposite can develop after the first couple of hours. Beginner traders tend to lose money in the middle third of the day. They often lose more than they have made in the first third of the day. And if that is the case, you should consider not trading in the middle third unless signals are especially strong. Many traders make most of their money in the first couple of hours of the day and then trade much less or not at all during the middle of the day. If a person owns 2 stores and one makes a lot of money, but the other consistently loses money, no matter what the owner does, and often more than what he makes from his good store, should he continue to operate both stores? The answer is obvious. You can look at the first and middle third of the day as 2 stores. There is nothing wrong with closing that losing store. Your goal is to make money, not to trade all day long. If the price action is good all day long and you are not tired, then it's financially wise to trade all day. However, that is usually not the case. The middle third tends to have much more two-sided trading, channels, tight trading ranges, many reversals, trend bars without follow-through, and loss of dojis. Unless traders are very selective with their stop entries or capable of making money by fading moves with limit orders, they should just wait for the price action to become more predictable. It is always better to not take any trades than to take trades where your losses are greater than your wins. Beginners frequently win just often enough to make them continue what they are doing, hoping that all they need is experience. However, no matter how much experience they accumulate, a tight trading range will always be difficult to trade. It is almost always better to wait until the always in direction is clear, so that the odds of follow through are high enough to allow for a profitable trade. It is worth noting that traders often get tired, and since their edge is small, they should refrain from trading if they cannot trade at their best. Traders can get tired, bored, or distracted at any time during the day and should not trade until they are back to normal. The computers don't get tired and trade into the close as well as they did all day long. This is another one of the advantages that they have over individual traders. Risk manager's job is to be coldly objective. Price action techniques work in all markets, but most day traders prefer markets that have many entries a day on the 5-minute chart and can handle large position sizes without slippage. The 5-minute standard and poor E-mini futures contracts can handle any other size that an individual trader can place. You will never outgrow it. This brings us to the end of these lessons. You can check our previous broadcasts for other important lessons, for example, on how we turn $3,000 to over $400,000 in about 4 months. Thank you.